I'm Charlotte McLeod with investingnews.com, and here today with me is Peter Goodburn, founder of WaveTrack International. Thank you so much for being here. Great to have you.
Thanks, Charlotte. It's great to meet you, actually.
Really good to be meeting you as well. It's our first time talking, and I think that many people in our audience are probably familiar with you and your work. But I thought to begin with just a quick intro to yourself and what you're doing right now.
hmm Well, sure. Well, my career in the financial markets began in 1978, and at that time I joined a company called Billiton, which might be familiar with some of your audience. They're a big mining group. Actually, in those days, back in the late 70s, they were owned by Shell, as were a lot of mining companies were owned by the oil conglomerates. Um, and that formed basically later into, or Billiton folded later into BHP, which was in those days Broken Hill Proprietary, but everybody abbreviates it. But we were ring dealing members on the London Metal Exchange, so commodities was a really big deal in those days. It was sort of really secondary to the stock market in a lot of ways. And the main contract on the London Metal Exchange was copper. It was also trading in New York, but because London had a different way of its mechanism, it attracted a lot of hedging business from all sorts of countries like Africa, China, South America, Chile, places like that. So it was a really exciting time to sort of get a baptism into commodity trading because back in the late 70s, it was like only a few years after Bretton Woods was disbanded, and of course there was huge price inflation going on. Prices were going up in a lot of areas, including precious metals. I know you're really familiar with those. And of course, gold was leaving the gold standard, in the 70s, and copper and other commodities were going through the roof. So that was a really exciting time. And of course, in those 2 years of initiation into the commodity scene, we had hyperinflation. Of course, interest rates were going through the roof, and the U.S. administration was sort of attempting to try and stem the dollar decline at that point in time. And actually, I've got an excerpt. I thought I found this actually, and I thought I'd show it to everybody. Um, this is an extract from the Financial Times. It was dated November 1st, and it's coming out of my diary from that year. And it shows just how ruthless the dollar decline was at that time, and just how the U.S. administration at that time was trying to defend the dollar's decline through all sorts of different measures, like drawing down from the IMF and the World Bank and so on. But that's just an extract from my early history. Later, after about 10 years in brokerage and fund management, I actually ended up creating WaveTrack International, and that was after the '87 crash in the stock market, and we've been running our book since then. And primarily, we're an Elliott Wave analysis group, and a lot of Canadians may be tuning in might know something about Elliott Wave because AJ Frost took over the baton from Hamilton Bolton, from Bank Credit Analyst, and they're still based. I think they're based in Quebec. I think the other side of where you are, but they were principally taking the baton of Elliott Wave analysis from Elliott himself, who died in 1948. And that sort of analysis is the bedrock of our company. And it's fairly deterministic, in which case it has predictive value. So we get a lot of ideas about where trends are developing from. And that's our specialist subject. And we've got an overlay of that a little bit because our specialist area within Elliott Wave is really ratio and proportion. So we tend to use that a lot in order to get amplitudes of different trends and stuff like that. So that's really my background.
Okay, well, really good to hear about your background and how you work right now. And of course, always good to hear about the Canadian contribution, because of course that's where I'm coming to you from. So we'll get into talking about some of the areas of the market you cover. And as you mentioned, precious metals is really a strong focus for us over here. So I was going to begin with gold. And if we could take a look at gold and where, based on your analysis, gold is in the cycle right now, just to start with a broad look at the market there.
Yeah, sure. Well, the gold price is quite fascinating because actually, if we're going to really take a look at gold, one thing we need to do is go back to a point where it was an extreme low, and that means going back to the Great Depression period, 1932, down here. So we need to begin analyzing gold from that perspective. Anywhere shorter than that, you're getting a sort of a fragment picture and trying to build a universe from a fragment picture, which can be a bit misleading. So when we're doing Elliott wave analysis, in order to understand what price development is like up and down, the swings and the amplitudes, it's really, really, really important to get long-term historical data. And even some of our data on silver, for example, goes back to the Middle Ages. We've got data, I think, from 1300. So, but gold really hasn't been much lower than this point in the Great Depression lows. And the trend is composed of 5 price swings. Now, Elliott wave denotes a trend, not just in the normal schematic that we use, where you've got higher highs and higher lows. That's the normal definition of an uptrend, where the price action is higher highs and higher lows. But in Elliott wave terms, we can be a bit more specific. We can actually say that an uptrend in this magnitude will develop into 5 price swings or 5 waves. And you can see the first wave, which is basically here. And then you have the second wave, which is a sort of a flat period because that's when the gold standard came in. And then once that was released during the Nixon period, we had a third wave. And then we had a correction down from 1980s peak here, 1999, 2000 for wave 4. And actually, historically, from this long-term trend, we're in a concluding 5th wave, which is, in a way, exciting, and also a little bit of a warning sign for later, in the years to come, that we shouldn't get too hedonistic with the price action because this is a concluding 5th wave. It's a multi-decennial rise from 1999. So we've got 2 decades of moving up so far. But by the end of this decade, we would have almost certainly had a peak. And if anybody's holding gold to any essential level that's meaningful, I mean, okay, a lot of individual investors might have a few gold coins, but it's not going to be life-changing. But if you've got a sizable amount of investment, either leveraged or otherwise, at some point in the future, in the not too distant future, before the end of the decade at least, you need to have a bit of a realistic change of heart and start looking at potentially taking profits, because gold's price action won't last forever, going up exponentially forever. At some stage, this 5-wave pattern will finish. Now, when a 5-wave pattern finishes, you're going to get a 3-wave correction. And the discoverer of this pattern, Ralph Nelson Elliott, said, when the correction comes, it normally retraces back to the low of wave 4 preceding, which is basically here. So that's a bit of a shock. So you're riding the surf. You're going up and up and up still over the next several years, but basically at some point you need to take a reality check and come back. So when we go back and look at the maybe shorter term picture, which might be more relevant for everybody, we can see that just last month, when we got to 3,500, and actually, funny enough, 3,500 is exactly 100 times the gold standard at $35 an ounce. That's a little bit of an interesting equation. W.D. Gann, the great analyst and trader of the 1920s, used to put 0 multiples on important highs and lows in order to gauge where the next transition would be. But 3,500, I believe, was finished a sequence of trend that dates back here to October 23. That was 1810. And we can count an Elliott 5-wave pattern up in that sequence, and we can measure it as well to depict a top. So I think that gold is on its way lower for the next several months at the moment. That we're going through again a transition of correction to the downside, and we've started with an initial decline down here to 3260, and we've undergone a noticeable Elliott wave expanding flat pattern there. It's very clear what that was, and it's trended down since. And I think short term there's a bit of a flip coming. We could get to 3350, but then we should start to look at a resumption to the downside. And if we're going to translate that into some downside targets that we have at the moment, I think we should aim for something like 2720 or 2518. We'll be able to tighten up on those numbers the more price activity that develops to the downside, because then we can measure those movements. But these are the preliminary downside targets you've got to think about. So if you're leveraged into trading gold, either through bullion or ETFs, or even some of the miners, some of the gold miners, some of them are looking a little bit top heavy. You have to understand that there is downside risk at the moment. Yeah.
Well, I think that gives us a pretty clear picture of the short term and long term that you see coming for gold, and makes a lot of sense to me. We can be excited, but also a little bit cautious being in this fifth wave time right now. I think a lot of people will hear that and think, okay, so in this fifth wave that we're in, what is the price potential for gold? When should I really be feeling cautious about taking a pullback there? So any thoughts on that note?
When you say cautious about being pullback, do you mean during this dip, or do you mean after the dip when it moves up?
I'm thinking after the dip when it moves up and we're in that final time.
Yeah. Well, I think that there's a couple of things. I mean, we're going to basically look at gold and what drives gold at that point. We're going to see how far it moves up. I mean, this was a very emotional movement up. I think mainly because actually, if you go back 18 months or thereabouts, the whole discussion on gold wasn't really whether or not gold was going to go up. I think there was a lot of conviction that gold prices would go up amongst the investment community. I'm not talking about the gold bugs who are always forever long. I'm talking about the external guys who are saying, well, I need to make money. Is gold a viable option to trade, and to invest in? I'm talking about the large asset managers and the hedge funds. But it was only recently that it caught the 1970s bug of going up because of inflation fears, and that was being obviously coming through from the tariff negotiations and the fact that there was a trade war going on. Now, as the stock market recovers, that's likely to trend up. Inversely, gold should come down. But just how far the next gold movement up occurs is going to be a very interesting proposition to analyze, because I think we'll go back to the long-term chart that I showed earlier. I think our top end range is about 38.20. I think that's about top end, and probably no more. But I have to say that when we look at the gold-silver ratio, and we can see that silver is very undervalued. I mean, we've been trading over 100 on the gold-silver ratio, which basically means 100 ounces of silver for 1 ounce of gold. And historically, we've never been, or seldom in the past, been at that sort of level. And when we have been on the two occasions in the distant past where we have seen the gold-silver ratio trade above 100, we've seen some very big declines, which means that silver outperforms gold. And that's something which I think is very relevant here, because we're looking at a chart going back to just off the 1930 lows. And if you go back to 1941, there were 96 ounces to 1 ounces of silver to 1 ounce of gold. But then in the post-war years, going into the 1970s, it went down to 1836. And since then, we've moved all the way out. This is the pandemic peak at 112. And you can see we're trading today at 98.8. This is real time. But and we've probably got a little bit more to squeeze out. This is a quarterly closing chart, actually intraday. If I zip to intraday, you'll see that it's yeah, we've already traded here at 107 last month. I think that we might squeeze up a little bit more, but that's it. And after that, we're really looking at a significant downtrend developing, and that means huge silver outperformance. So I think that we should switch our thinking around a little bit, even though gold currently is working its way lower in this correction down for intermediate wave 4, down to our 27.20, 25.36 max target area. When the market starts to trend up again, I think we take another look at silver, because I think silver, basis the gold-silver ratio, has a lot of downside potential that narrows the spread or narrows the ratio in silver's favor. It's not quite ready to go yet, so I think we have to be a little bit patient, but it's almost there, you know, to a point where you say, no, I'm buying silver over gold.
Yeah, I think that's a question that a lot of people have. What should I favor? Is it gold or silver? So that sheds some light there. If we look at silver, is it going through, you showed us the five waves for gold. Can we see a similar pattern emerging in silver, or how does it look to you?
Yeah, it's the long-term picture is a little bit different, but actually it still delivers a very big upswing. Now, um, this is um, this is a very long-term silver chart. It goes back again to the Great Depression lows. Its orthodox uptrend of five waves, which we saw earlier on gold, actually peaked in 1980. And I think that we're going through um, a corrective pattern, a multi-decennial corrective pattern, where the first sequence down of the correction was back here. So this is the low in 1993, when we were $3.48. And I think this swing up is wave B of a larger corrective pattern. And I think we could get to $70. So it's going to be very difficult to really double your money in gold at these price levels, even after a correction. I think it will be difficult if we get down to 2,700. It's going to be difficult to get. It's difficult to get to sort of $6,500, $7,000 on gold to keep pace with silver if it goes to 70. But I think 70 is a very easy proposition for silver, basis the gold-silver ratio. So I think that a long-term investor definitely needs to be buying silver, and I think that I think that will be very fruitful. It's just a question of where do you step in? Do you step in now or wait a little bit to the downside? I'd probably wait and see if we could get a little bit lower on silver before buying it. And the other thing that that's very interesting, talking about which precious metal to buy over gold, is platinum, because the gold platinum ratio, wow, that's incredible. Here's the long-term gold platinum ratio. And again, we go back to the 1920s, but this is where the ratio was its narrowest point, and where at its widest point, as far as the last 100 years goes. That means platinum is very inexpensive. And molecularly, you know, 1 ounce of platinum, one little bar of platinum, is going to actually be slightly smaller than an ounce of gold, because the molecular compression is higher. And that has a lot of offering in terms of new technology, which probably will come on stream in the next year. So I think that we're not quite ready to buy platinum over gold yet, because this sequence has still got enough momentum upside to even take us a bit higher. And I'm watching platinum very closely on a day-to-day basis for its completion of its correction down. But at some point, platinum will outperform gold, and I think it may even outperform silver, which is interesting.
And it is very interesting. I know platinum is one that a lot of people have been watching as it kind of goes in that sideways motion. So that would be very interesting to see if it could finally make that breakout. I'm wondering your thoughts on the gold stocks and perhaps the silver stocks as well, because typically we hear that they will outperform the metals. Is that something that you see coming, or what are your thoughts?
Well, in 2016, back end of 2015, we turned very bullish because that was basically, this is GDX, and we turned bullish down there because we saw a very succinct corrective pattern that dated back to March '08. That was the top of the financial crisis. And this pattern is called an expanding flat pattern. And we had forecast this decline almost to the dollar. And we went really bullish. And then suddenly from 12.40, we went up to 31. So we did 2.5 times multiple getting up there, almost 3 times multiple. And gold only did a 30% run higher. Gold bullion only went up 30%, where this did 250% or more. So we thought, wow, okay, this is, we know that this was a major low. This is a new bull market. And that gives us the impression that the gold miners would outperform bullion in going forward. But actually, in this last period of the last 18 months or more, gold bullion has been the one to hold, not necessarily this. I mean, okay, this has doubled from 21. This is going back now to September 22. And October 23 was when the last acceleration up for intermediate wave 3 occurred for gold. And this one has done pretty well. I mean, they have done pretty well, but not as much as I originally thought they might. And the pattern adjustment that we made in our analysis shows that there's somewhat more limitation going on here than we thought before. But there's still upside gains in multiple terms to be made. Maybe not from here, because we're currently today just below $50. And looking ahead over the next several years, I think the maximum we can get to is probably 100, just above 100 here. But what I'm concerned about in the shorter term, which means over the next several months, whilst gold bullion trades lower, I think the gold miners will tick back and fall back inside this range. The range is basically 45.78 here to 21.52. And we've seen a slight nudge above that high. For some people in technical terms, that would be a buy breakout. But that for me is not, because in Elliott wave terms, that's only possible if there's a 5-wave pattern. But we've only got 3 waves up here, which is a very dangerous sign that this gold miners want to fall back inside the range. And we can see that consistently with the XAU, the gold silver index, and we can see it with a lot of the, some of the major miners. Newmont Mining, I'm not sure which ones, Agnico Eagle maybe, and Anglo Gold, Ashanti. They all look very similar. Maybe we can have a look at Anglo Gold, Ashanti. Let's have a quick look. I think there's a similar construct. Yeah, there's a similar construct. So we've had basically the movement down, but 3 waves up here. This is really dangerous. So if this starts to fall back in the next weeks and trades below 38.50, I'm afraid that means it's going to fall quite hard back inside the range. But that's consistent with the bullion idea that on the bullion prices, we're going to pull back as well. So, but later, of course, if we were fortunate enough to trade back towards this low, which I think is possible, then, of course, the multiples begin to work in our favor again, because the next swing up will take us up to 88. So if you go from 12 to 88, what is that as a multiple? There's some pretty good math people probably listening in. 6-7 times multiples. So there is going to be huge, you're not going to see that on gold bullion anymore. You're not going to get 6-7 multiples on gold bullion. No, that's not possible. So yes, there are going to be some really exquisite trades to be made on the equity side of gold miners, but I think we have to ease off a little bit now, because I think there's certainly downside risk in the next several months.
Okay, okay. And I think a lot of people are used to seeing that maybe in the summer where we see that type of pullback. I'm curious to get your thoughts as well. So while we have this gold and gold stocks taking a break for the next few months, what do you see happening in the broader stock market in the US? Because I think there are people that I speak to, I see in our comments section, people are thinking, okay, there's going to be maybe a big pullback there. We're not sure what's happening. But you've done published some recent research that I think kind of shows the opposite happen, where we have a higher move there in the overall stock market.
Well, that's right. I'm just going to, this is actually an excerpt from our latest Elliott Wave Navigator report. And actually, the theme here is really looking at the FANGs and the semiconductors because they've been, of course, the Mag 7s. You know, they've been all the leaders before, and they fell out of favor back end of last year and certainly responsible for the larger percentage declines that we've had since December into the April lows. But before we take a look at some of those, this is the broader benchmarks, the S&P 500 traded in New York, and we're going to take a look at the NASDAQ. But this was our forecast from our annual reports that we published in December. And at that time, the S&P was finishing a rally from August. And we had recognized actually that this rally from August at 51.20 into the December high was actually the second sequence of what we call an expanding flat pattern. And the archetype pattern that we've identified is actually here in this tutorial. So the orthodox correction actually began in July earlier, 57.21 down to 51.20, which was wave A. And we said that this B wave will break into a new high, but then it will collapse and it will break the August low. So in other words, we're going to come down to 51.20, ran up into December, and then we're going to have this massive 20% drop that's going to take us towards 4,900. And once it gets down there, then it's going to attract new buyers and start to develop to the upside. And this is the actual pattern that we've updated. And you can see now, here's the top in December, and here's the collapse down to that 4,900 level. We actually got to an orthodox low of 48.71 and 3/4. So just slightly below the numbers, but then whoosh, straight back up again. So when you make a forecast like this, where it's predetermined, so you're actually measuring the type of pattern that is expected to develop downwards in this manner, and it hits the numbers and then reverses back up, you get a very high conviction level that you've correctly analyzed the pattern. And since then, the S&P and the NASDAQ have been trending up in a very strong manner, which suggests to us that the uptrend has resumed, despite the narrative, of course. Here's the NASDAQ, the same pattern from July down into August, 3 waves up in wave B for this expanding flat pattern, and then C down. I think we were a bit ambitious with this one. We talked about 15.5, 16,000. I think the actual low was 16.4. But it broke the August low, which was the prerequisite minimum condition, and then straight back up again. So all of this looks bullish, and we're ready for the next major uptrend. So I mean, for the NASDAQ, we're talking about 31,500. So we're talking about a good, what is that, 25% maybe, something like that, going up over the next several months. And I think this movement, this trend up, is part of a larger pattern which we recognize from the pandemic lows back here. And this is the last phase of the secular bull uptrend. That when we start seeing this movement up, now that we've started to 31,500, this is basically the reason why I think gold is also going to be trending down for the next months, because basically before that we had gold moving up with the background of the tariffs and the inflation aspect. But if the stock market's trending up now, there's no reason to hold gold in the same manner anymore. So I think gold will gradually start to see liquidation as the stock market goes up. So you'll get these two diametric opposite movements of direction in the two different asset classes like that. So yeah, I think we're very bullish, and I think this particular report is our Elliott Wave Navigator. So we actually look at, if anybody's interested by tuning in, we look at all the Mag 7s and a few others, but also a lot of semiconductors, which are very relevant. Yeah. So I think we can be very bullish for stocks now, and I think it'll take a little while for the big asset managers to click into this idea that they've missed out a little bit at the April lows. I think we know from the data stats that actually it was the small investor that was buying at those lows, not the big asset managers. So they've missed out a bit. So they're going to have to catch up a little bit.
Yeah, I think you can really start to see how these different components fit together. So that makes a lot of sense when we look at them one after the other. I'm curious, so you're really focused on the patterns, and I'm wondering how much you take into account external events. So, for example, this week we've got the US-China trade deal really in focus, or interim trade deal. Last week we had the Fed and interest rates, inflation really in focus. Are those things you're paying attention to, or how are you counting those when you do your analysis?
Yeah, well, sure, we are paying attention to it. I mean, most of our institutional conference calls with clients, hedge funds, and some of the big asset managers and the pension funds are all about the fundamentals. I think the people that know us a little bit know that we focus on the pattern first and foremost, and the amplitudes, and then we look for the fundamentals, how they fit with our synopsis. Um, so, for example, I mean, we had absolutely no idea at the time when we were looking at the Nasdaq dropping down to these sort of numbers, what the catalyst might be. We could hypothesize, of course. We could say, right, well, we're looking at a 30% decline for the Nasdaq from the December highs. What is going to trigger that? So when we start talking to our institutional clients, we are discussing what the fundamental external exogenous events might be. But where basically most of the discussion is what catalyst do we think will augment the analysis, not the other way around. So our primary focus really is on the pattern determination. I've given you a pretty good example of how we can forecast these in a very accurate manner um, without having to stretch the imagination too far. And then when the narrative comes in, we can basically fit that around. At the moment, the narrative is still around tariffs, of course. Why should the market trend upwards and continue upwards in the months ahead? Well, we can again put a hypothetical statement around that and wrap it up and say, well, obviously, the whole tariff situation will settle down and various different countries will come forward with their own proposals to settle the tariff war with the United States. But that's, I think, a very logical outcome to what we have. But generally speaking, pattern and price amplitude comes first in our analysis, and we then discuss what the potentiality is for the fundamental picture to wrap around it, really. Yeah.
Okay, okay. Thanks for going into that. I think it makes a lot of sense. And just because we do have US and China in focus right now, I did want to take a look over at rare earths because I know that's a part of the market that you cover. And I don't get a chance to talk about it very much, but I think it's important as we have these tensions kind of emerging. So I'm curious what you see coming for rare earths. I know you look at one of the ETFs and maybe some of the larger stocks. What would you want investors to know about that sector?
Yeah, I mean, unfortunately, we don't have very, very long-term data on rare earths to analyze, but what we have got is enough to give us a bit of a synopsis of what to expect. Um, this is the Van Eck Vectors Rare Earth ETF. I think it's REMX. And what was very interesting from us is, of course, a lot of markets bottomed in 2020. Some made secondary lows. The base metals like copper made secondary lows, the pandemic lows. They didn't break the 2016 lows. Um, but things like crude oil made a lower low in the pandemic lows, which is technically very interesting from our perspective to analyze. And rare earths did as well. And since then, because they were major lows for a lot of other commodities, we can see that what unfolded afterwards was an Elliott 5-wave pattern again. So we can see again waves 1, 2, and then we get price expansion, which is typical for a third wave, a bit of retracement for 4, and then eventually a fifth wave. Now, whenever a 5-wave pattern like that runs up from an important low, a correction has to follow. Normally, it would trend back to wave 4 preceding, and then it would finish. There's some exceptional circumstances where it drops lower. And this is one of those where the decline, and this is almost, I think, 75%, is traded all the way down to 32 bucks, which is incredible given that we've rallied 5 waves beforehand and had a correction down. It's screaming out to be bought just from a risk reward basis, because don't put too much leverage, but an ETF doesn't have futures expiry, and you're not leveraged so much in terms of you're not going to get margin calls once you buy it. But um, but if you did buy this, you've got huge upside potential, really huge, because even if this pattern is just a corrective zigzag, I'm being a bit technical, so excuse me for that, but the proportions for that tell us to extend this by a 61:8 ratio, which is a golden ratio from the Fibonacci sequence. That produces a target at 359. I mean, yeah, risk reward, you're risking a stop loss below 24.39 for something that's going to mean a tenfold experience to the upside. So it looks phenomenal. I think it's definitely worth part of anybody's portfolio to look at an ETF like this. And if we take a look at MP Materials now, they were mentioned in a recent administration from the US, because I think Trump talked about adding to the strategic reserve, right? I think there was mention of that. There was a couple of companies mentioned. MP Materials is the largest rare earth company traded in the US, has a physical presence in the US. And here is the same decline that we saw on the Van Eck Vectors movement down. So we've gone up in 5 ways from 991. It's traded basically a double bottom to 10 bucks. And now this one's outperformed Van Eck Vectors. It's basically traded up here to 29.72. I think that flip up was during the announcement that the US administration made, saying that they're looking into adding rare earths to the strategic reserve. And this is going through a little bit of a correction down at the moment. But in the broader context, this should trade up to, I think, at least we've got a target at 97 bucks, maybe a couple of years from now. So some fantastic percentage increases coming for rare earths. And why not? If it's going to be added to the strategic reserve and the pattern fits, I think that, again, it should be part of someone's portfolio.
Yeah, I think taking a look at this, it's definitely one where, like you're saying before, where the chart fits kind of that external narrative of what's going on with rare earths. So very, very fascinating to look at that. And I don't want to keep you overly long today. This is really interesting. Are there any other areas I would ask you before I let you go that you find interesting in the market? It can be commodities or otherwise. I think you've already highlighted so many interesting things for us.
Well, I think that crude oil is a fascinating long-term directive. One of the things which we talked about, well, this is going back to the financial crisis sell-off period in 2008. When we started seeing the recovery from the lows in March 2009 in the stock market, they started the next secular bull market. People refer to the secular bull market in stock markets beginning from that junction low. So I think that was about 666 from memory on the S&P 500. And we're still involved in that secular bull uptrend. But for commodities, a lot of commodities, their orthodox peaks from long-term uptrends are not still in play. If we take a look at oil, for an example, now we're going to look at something really long-term on oil. We're going to take a look at crude oil from the 1930s. So here's the Great Depression lows. Now, what you'll see in a lot of commodities, including some of the base metals as well, like copper and aluminium, they bottomed in 1931-32, and they've seen 5 waves up over a very long-term period, an Elliott 5-wave pattern. and they topped out pre-financial crisis. So these are the highs that we saw in 2008. This is, I think, it should be July 2008. And then we had to undergo a correction. Now, again, Eliot said in his original works in 1938 that a correction should return back to wave 4 preceding. Well, here's wave 4. And the range is somewhere between 36 and 1670. The extreme low of the range is $12. And oil prices, of course, they had this rather exogenous sort of strange trade down to 650, but it came back to wave 4 preceding. And this was the minimum retracement target that Elliott talked about. The reason why we got to 650 was because somebody was long, and of course they didn't want to take delivery. And it's a deliverable contract in New York, so they dumped. But you didn't see the same exaggerative sell-off in Brent oil. Brent oil was about $16.50. This was $6.50. So there's a bit of an exaggerative sell-off there. I think in normal circumstances, it might have bottomed around 1670, actually, somewhere around there. But the interesting aspect to the oil is that this decline at 650 doesn't begin a new bull market. We described this advance as the inflation pop period, where risk assets would go through some very big price accelerations to the upside. Stock markets, for example, fit into that model of the inflation pop. They're very overpriced historically, but people are still buying them because they believe in the price going up. So that generates even more buying. And it will continue for the next few years until it eventually pops, and then the bubble will burst. And then we realize that we've been trading a Ponzi scheme for these last several years. But the same with crude oil, which is a very good barometer because it has a different pattern to the stock market, but it's caught up in the same asset strip. And the inflation pop, which I call most commodities trending up either from the financial crisis lows like copper or oil from the pandemic lows, is designed to have one big splurge to the upside. Now, we haven't quite finished the correction down from the March 22 highs yet in crude oil. I want to see sub $50 before we start buying it in a very significant way. But I think that we're going to see plus $200 at some point on crude oil before it collapses later. So this is what I call the inflation pop. I developed this idea of the inflation pop expression back in 2010, 2011 to say that we've got two diametric different patterns developing on stock markets, which is still part of the risk asset group, and commodities, which had their orthodox uptrends from the Great Depression lows finishing in July 2008, and copper finishing in 2007. So we've got a very different structure that's developing since then. And if you understand the structure of how those two different asset classes are working, you can basically then get a very stringent idea of how the future price development will occur and how it will develop and the amplitudes it will develop. So this difference it's like, I suppose, taking two different things, but when they give the same results, you get a very high credibility and a high integrity of the outcome. And so we've got a very exciting time to come, actually, with commodities, with the gold stocks that we saw earlier, which can see big multiples to the upside following a correction this year. And that's part of the inflation pop, so there's some fantastic things to be involved in for later, but it's not quite ready yet to be placing more money into commodities at this stage. I think if we're placing money anywhere, it should be the stock market.
Yeah, I think based on what you've laid out, that makes a lot of sense. We'll be a little patient on the commodities, but as you said, exciting things to come. I think that's a nice place to wrap it up. You've given us really a lot of ideas to think about, unless you had any final thoughts to share with investors.
I think you just gave me the chance to conclude with oil. I think I'll stop there.
Okay, well, very good, very good. Thank you so much for coming on to go through everything that's going on. This was really interesting and hope to do it again soon so we can see how things start panning out in the future.
I hope so too, Charlotte. Thanks very much. I've really appreciated our journey together today.
Oh, me as well. And once again, I'm Charlotte McLeod with investingnews.com, and this is Peter Goodburn.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.